Welcome to Big Idea Investing. It's your host, Dylan Loomis. So I just got off ARK's March market update and I wanted to share a few quick takeaways with you. Cathie started off talking about good inflation and bad inflation and related it specifically to the EV revolution. She reiterated that this is taking place much faster than anyone has really anticipated, and a lot of it's being driven by Wright's Law, which, if you're not familiar, basically just says that with every cumulative doubling of production in the EV space, it will lead to a roughly 28% reduction in overall battery pack costs for electric vehicles. And Cathie once again reiterated that traditional auto is in big trouble because of their lack of willingness to invest in disruptive technology because they've been focused on short-term profits for shareholders. And she said that by 2025, they think the average price of a normal electric vehicle will be about $18,000, something similar to a Toyota Camry today. And if that comes to fruition, then of course
demand for electric vehicles is going to explode.
So if you don't have some exposure to the EV space in your portfolio, now would be a good time to start. And at the end of the webinar, they actually talked a lot about Tesla and how they are still 3 years ahead. So if you want to see that full clip, you can check my Electrified channel below and it's posted over there. Cathie also touched on the inflation fears, but she spoke about all of the deflationary factors in the market right now, like innovation. And one key one was the velocity of money has been low. The velocity of money is just basically if people are spending money or saving, and to date over the past year or so, people have been saving at much higher rates. A lot of it's due to the pandemic and loss of job and other uncertainty about the market and economy in general. But because of those factors, ARK is not that worried about inflation, at least in the near term. And I do have one quick clip that I thought was really important and I'll share momentarily, but Cathie did touch on the rotation from technology into traditional value stocks that she actually thinks could be big value traps, and I fundamentally agree with her. So listen to this clip from her on that topic.
What has just happened in the equity markets is a massive and severe, I guess from our point of view, severe rotation into value stocks. This started in the fourth quarter, but it was a mild rotation. And we were surprised at how well, innovation-based strategies performed during that period. The rotation just took off in the last few weeks with interest rates. So I think while many were worried about interest rates and the equity market did go down, what happened was something very healthy. The bull market broadened out into value in a more serious way. This is something I had expected soon after the coronavirus fears started diminishing, and I've been surprised at how long it took to happen. This reminds me of 2016 when President Trump won the election against expectations. The market incorporated immediately lower tax rates and cyclical friendly policies. So value took off, and growth generally, and certainly innovation focused growth, sold off, actually declined as the market was taking off. Feels a little bit like that now. And I gave the answer to this question, is the equity bull market at risk? Back then I said, no, if anything, the bull market has just broadened out. It is becoming stronger. So that's good news. If interest rates are a concern. However, when I think about, and that's valuations, of course, when I think about interest rates, I don't believe the market ever priced in 1%, 1.5%, 2% long-term treasury yields. And the way we know this is, and it did strike me, I was puzzling over it for many years, that every time the S&P 500's PE ratio moved into the 20 to 25 times range, the market sold off. It had become too stretched, according to most investors. That suggests that investors were thinking about normalized interest rates. They never gave the market credit for the interest rates as they were falling towards 0.5%. The assumption was, no, we have to base our valuations on normalized interest rates. And it looks like that's probably in the 4 to 5% range, which was the range for GDP growth for many years, nominal GDP growth. We think there has been a structural shift down in nominal GDP growth for two reasons. One, the innovation that we analyze all day long, it is growing very rapidly, 30, 40, 50, electric vehicles, 80% annualized rates. But their bases are too small to move the needle on GDP. Meanwhile, they're starting to disintermediate and disrupt the traditional world order. And as I just described, we're probably going to see consolidation and difficulties in wide swaths of the economy. So we would not be surprised if the true normalized interest rate is closer to 3. So if 4 to 5% normalized is associated with 20 to 25 times as a PE ratio, 3% would be associated with 33 times. So a lot of investors are wondering, how high is high in terms of valuations? We may have gotten a glimpse of what is about to happen to the market as innovation was rewarded handsomely with valuations that even we, watching some of these IPOs and SPACs come out, even we think are way ahead of themselves. But maybe this is a clue that real growth, true underlying growth, is that scarce, and there should be a reward for it. We're not betting on that. The valuations we use 5 years out are more in line with today's valuations as we are setting our price target. So we're not betting on it. We're just saying, I wonder. And then the final thing I'd like to focus on is money market funds. Another clue that velocity is falling, and maybe falling a little faster now, once again, is money market mutual funds are higher today than they were in 08-09 at the depths of the crisis when everyone was rushing into cash. They had started falling, but they've turned back up. And that might be because of the risk-off environment we've just witnessed. So there's a lot of cash on the sidelines. And if we're right that the bull market is broadening out and that valuations are in a decent range now, if we were using 200 on the S&P 500 and the S&P 500's at about 3,800, that's 19 times, we're below where the S&P usually stops, and we think we're in a strong profit recovery. So we're actually looking at this combination, broadened bull market, lots of cash on the sidelines, valuations having been taken down in this last period. And we're feeling pretty good about the equity bull market. But again, as always, stock selection, active management is going to be key, because there are going to be a lot of value traps out there.
And ARK actually mentioned a company that you might not be familiar with called Quantum SI. They're in the proteomics space, which is basically the studying of proteins, similar to how genomics is the studying of the human genome. So this company, I'm just going to read, they are actually in the midst of a SPAC deal with High Cape Capital. And so basically this transaction will merge Quantum SI's revolutionary end-to-end proteomics solution and High Cape Capital acquisition, a healthcare-focused SPAC sponsored by leading healthcare growth equity investment firm High Cape Capital. The pro forma equity value of the business combination is $1.4 billion, with a combined company expected to have an estimated $514 million in cash after closing. And this news came back February 18th. 2021. So I was considering doing a deeper dive video on this company. If you're interested in something like that, just leave me a quick comment below. But as you can see, Quantum SI has created the first next-gen protein sequencing platform with the goal of revolutionizing the growing field of proteomics. Our unique semiconductor chip has the power to decode the molecules of life, starting with proteins, and holds the potential to expand the scale of the genomics and proteomics market beyond that of next-generation DNA sequencing. QSI's end-to-end solution, including carbon and platinum, which is on track to launch commercially in 2022 for research use, has the potential to significantly disrupt an existing addressable $21 billion market of pharmaceutical academic research and drug discovery. The platform may also enable new diagnostic applications in healthcare. Another takeaway that I thought was really interesting is in the cable or linear cable space relative to the new streaming platforms like Roku, Amazon, etc., Apple TV. So the sports contracts have been one of the main things remaining where the old school cable still has an advantage, but those contracts are actually expiring, as you can see from the chart, in the next few years. So ARK actually believes that these new streaming services have the market share as well as the money to swing some of these potential sports contract deals to their platforms over the next few years. So if that happens, that's going to be a huge deal when it comes to cable and these streaming services. As we know, it's a really fragmented space right now, but that is something to keep an eye on in the years to come. And one other thing I wanted to mention, Cathie reiterated that during market sell-offs, they are selling their lower conviction holdings, which I think a lot of us knew by now, but they actually get some tax benefits from doing this that definitely goes overlooked. And she said they were going to touch a bit more on the logistics of how ETFs actually work versus mutual funds, which was actually a video topic I was planning to do here shortly, but they're going to have a specific webinar just for that in the future, so we'll definitely be on the lookout for that. And yes, she also said that it's during the market sell-offs where she believes ARK is going to be well positioned to, over the long term, produce the most return. So it's through the sell-offs, although they may be painful, that's where she can actually generate some of the biggest returns over the long term. So it's not all bad news. But that was all that I wanted to get out to you guys right away. As mentioned, I'm sure the full webinar will be uploaded soon, but let me know what you're most interested in for future videos, and I'll definitely read through all of the comments. But thank you guys for watching. Please take a second to like this video if you did. Consider subscribing for more investing content, and I hope to see you in the next video. I hope that you have a great day.